Sorry.
No problem.
Good morning, everyone. I'm your host, Ben Hofferman, and we appreciate you making the time to be with us this morning. We understand how valuable your time is. Little housekeeping. Attendees are in listen-only mode. We left plenty of time for questions at the end. Please use the question and answer box to submit any questions you have, and we will try to address them all at the end of the presentation. And at the end, we'll provide contact information for those of you that wish to continue the conversation. Thanks again. And Matt, take it away.
Thanks, Ben. And thanks for everybody for taking the time to join us today on this webinar. As the title slide indicates here, we're going to talk through state and local tax issues in the construction industry. This is my bio here. I've been in state and local tax for most of my career. I've kind of seen it from several different angles. I started my career in Big Four public accounting. I've also worked in a large law firm, and I ran the indirect tax function for a large manufacturer for a while as well. So kind of seen state and local tax and construction contractor issues from a lot of different angles throughout my career. A little bit of an agenda here. We're going to talk through common sales and use tax challenges. We're going to look at some of the exemptions by state. We're going to talk through some of the benefits of engaging a SALT team and reviewing your operations and how the different tax implications can impact you. And then, as Ben mentioned, we'll leave time at the end for Q&A. So first topic here, a big one. I'm sure most of you, this is probably from a tax perspective, top of mind for you, but sales and use tax is obviously a big issue in this industry. It's complex. We'll see some of those complexities today. We'll talk through how the various states deal with that. We'll try to give you a general framework for how to analyze some of these questions, and then just go through some of the things we're seeing on a regular basis in this space. So yeah, this is we've got a graphic up top that kind of talks through or highlights some of these challenges. But the common questions I get on a regular basis in this space, first, does a contractor pay sales or use tax to its vendor, or does the contractor charge sales tax to its customer? So what we're really talking about here is a contractor kind of in some ways sits in a tax landscape, at least from a sales tax perspective, almost on like a teeter-totter. That's kind of how I think of it. And it's either you're falling on one side where you're treated as the end user of that item, and then at the other end of the teeter-totter, you're treated as a retailer that's selling tangible personal property, and your responsibility in that case would be to collect sales tax. So it gets a little complex, and that's really kind of a threshold issue in this space, is whether you're viewed as the end user or whether you're viewed as a retailer that's selling tangible personal property. If a contractor's customer is claiming a sale is exempt, what exemption certificate can be accepted? We run into that a whole lot, whether the question is, can another state's exemption certificate be accepted? Whether is the manufacturing exemption applicable? Also, if what's being installed is something to real property, general resale certificate's not going to suffice. So we get a lot of questions around that, and it kind of builds some on that first common question we talked about there. Can a contractor's customer's exemption certificate be used by the contractor to purchase the materials tax-free? So as with a lot of these questions, the answer is it depends. And it depends, it varies by state, and then it varies also by what type of contract we're talking about. So sometimes if you're dealing with an exempt entity, that certificate will flow through and allow you to purchase the materials tax-free. Some states would say it cannot, and some states would say it depends on the specific entity that you're dealing with. And we'll see some examples of that later here in the presentation. Does a contractor need to self-assess use tax if the vendor doesn't charge sales tax? Well, and we'll talk through that again. So a lot of times this depends on whether we're in that real property landscape or whether we're selling tangible personal property, but we'll talk through that. And then, how are construction contractor sales tax issues handled when a contractor purchases or installs materials outside of their home state? So we're already kind of in a complex area of law. A lot of times a state will have a whole sales tax section devoted strictly to construction contractors. So as I'm sure many of you are aware and probably deal with, when you layer in another state and two states are trying to get a piece of the pie, more or less, it does get pretty complex. We'll talk through this, but in general, what's going to happen if you're paying sales tax in two states, or two states are saying something's, one state's saying it's subject to sales tax, another saying, hey, you're using it in our state, you got to pay use tax. There is a credit mechanism in most instances, so you're not going to really get taxed, at least at the full state rate in both states. The general framework, we touched on this a little bit, but if we're in that real property scenario, the contractor is going to pay sales or use tax and then in turn doesn't charge the customer sales tax. That's because they're viewed as the end user in that scenario. Want to point out here that it doesn't prevent the contractor from building in the sales tax into the price of what they're selling. In general, if you're in the real property framework, though, you can't itemize that out as a separate item. You can't say sales tax on the invoice or have any type of notation that says sales tax included in the purchase price, but nothing prevents you from building that into the price and effectively passing that on to the customer. If we're talking about tangible personal property, the contractor, the tax collection responsibility, unless there's an applicable exemption. So in that scenario, it's really no different than selling tangible personal property. There's going to be exemptions that might be applicable. Maybe it's being sold to a tax exempt entity. Maybe they're turning around and reselling it. There could be a number of different things that are applicable there, but in general, you're going to have the tax collection function or tax collection responsibility if you're viewed as a retailer. Got a note over here. So I get this question a lot. We'll flush this out a little bit as we move through the presentation, but a big one is the manufacturing exemption. The manufacturing exemption in general is only applicable for sales of what's considered tangible personal property. So if something is being installed into real property and we're dealing in that real property scenario, most states are going to say the manufacturing exemption is not applicable. Pennsylvania's language on this is very confusing, but I cite a case here, Golden Eagle Construction. I feel like that opinion does a really good job of explaining how the manufacturing works for contractors and those type of things. And they just lay out a pretty thorough analysis in that case. And I think in general, most states would conform to some version of that. I would definitely recommend checking the relevant states' laws on that, but I feel like this does a pretty good job of being a framework for what most states follow in that respect. So now we're specifically talking about Pennsylvania here to start. So our general framework that we touched on earlier, that's applicable to Pennsylvania. If it's property contract, or in Pennsylvania language, if it's viewed as a construction contract, you're going to pay tax on the purchase of the materials. Some examples that qualify in Pennsylvania as default real property or construction activities, a drop ceiling, an overhead garage door. Also list a couple of cases here that kind of shaped the Pennsylvania law in this respect. So the Sheets case, that was a gas station case. It was dealing with gas station canopies that were to the gas station, and they were essential to the property's use as a gas station. And then they were also intended to be permanent. So when you look at these cases, or you're trying to make that determination of whether something is real or tangible personal property, you'll see similar kind of requirements or prongs in most states. Affixed to the land, that's a key phrase. Intended to be permanent, essential to its use as that thing, meaning that if some other bought that property, I mean, they're stuck with a gas station. This thing's going to be a gas station. It's a gas station canopy that's affixed to the land. So that leans more towards making it a real property there. On the other end of the spectrum here, we see some cases where, like in Beck Electrical, we see electrical distribution system equipment. And the key facts there were that it's easily removable and non-permanent. So kind of the flip side there, those type of facts, something's non-permanent, easily removable, that's going to make it more tilt towards tangible personal property. Northeastern Pennsylvania Imaging Center, they were dealing with MRI machines in that case. And again, the court focused on the fact that they were removable and non-permanent. So just to give a little flavor of what kind of falls into each bucket, if you're dealing with this question, whether something's real or tangible personal property in Pennsylvania, the starting point is this regulation. It's 31 PA Code 31 2011, and in that regulation, it's quite old, but they list a whole bunch of items that are either considered construction or considered sales activities. And those items are by default construction or sales activities. Doesn't mean that you couldn't have, for example, potentially a transformer that is real property. Maybe it's affixed to the land, it's essential to the use, it's intended to be permanent. It's not a 100% if it is listed under one item or one category or the other that it can't be something else. But that's your default starting point, and in general, that's probably going to hold true. And it also gives you something to point to. You're not just kind of analyzing these somewhat subjective standards. You're saying, look, here's the PA regulation that by default is considered real property or tangible personal property. So this is a real life example here, one I recently dealt with. So concrete company. So think here of your, concrete truck going down the road. It's got the mixer on top. That's what we're dealing with here. The company manufactures or produces concrete. They're taking it to a location and pouring it. Eventually, this thing's going to be a building foundation. So that's kind of our set of facts here. In scenario A, the concrete company pours and smooths the concrete. And then in scenario B, which is, in my experience, much more common, the concrete company pours the concrete, but you got a third-party company that's actually smoothing it into the building foundation. So, and you see the language I highlighted there. This simple change in facts changes how the outcome of how this is treated from a sales tax perspective. In the scenario A, the concrete company is underneath the real property umbrella, so they would be responsible for remitting sales or use tax on that. In scenario B, they're viewed as selling tangible personal property to the company that's smoothing it into the building foundation. In this case, the concrete ingredients, the water, the stone, that stuff was broken out on the invoice. So they're making that sale to the third party that's smoothing it into a building foundation. It works both ways as far as, in general, somebody's overpaying or underpaying if this is getting messed up. So in this case, we were able to secure a large refund. And it's just something you want to examine. The facts really matter. And this example just highlights that even a small change in facts can really impact how the sales tax is handled. Yeah, and then the answer here, like I indicated in scenario A, the company is responsible for sales and use tax because it's considered a real property contract. Scenario B, they would be able to claim the manufacturing exemption and likely the resale exemption as well. And so they're going to have a tax collection function from the third party that's doing the smoothing. So now handling sales tax, and now we're talking about some services to real property. Some of the common services that we see: repair, maintenance, those type of things. So for items a contractor's working on that are real property, an example would be an electrical system affixed to real property. The determination on the taxability is analyzing whether what's being done is considered building maintenance or what is being done is considered a repair. Pennsylvania, building maintenance services and building cleaning services are subject to tax. However, real repair services are not. So that distinction is important in Pennsylvania. I think of repair services as bringing something that's down back into normal working order. So kind of what you would think of a repair: something's broken, you're fixing it, versus maintenance might be more routine. Maybe the machine is still in operation and you're simply maintaining it. In those instances, that is generally going to be taxable, whereas if it was a repair, it would not be taxable. So services to and then a note here on services to tangible personal property. In Pennsylvania, most services to tangible personal property are taxable. So both repair and maintenance services, if something's being done to an item that's not affixed to real property, that falls into that sales bucket in Regulation 31, that service is generally going to be subject to sales tax. So now we get into one of the items we mentioned earlier on about operating essentially in multiple states here. So if you've got property that is purchased or leased and delivered into Pennsylvania, it's going to be subject to Pennsylvania sales tax. And Pennsylvania does not have a temporary storage exception like some states do. So property that's brought into Pennsylvania and it's simply there to get attached to other tangible personal property and then it's leaving the state, or maybe it's brought in and it's just getting fabricated and taken out of the state, Pennsylvania is still going to tax that. And because they're say that sale is sourced to Pennsylvania, it was delivered here, that's a taxable sale in Pennsylvania. I want to note that that doesn't then prevent the state where that item is being taken into and used from imposing their use tax on that. So now you're in you've got a little conundrum. You've paid sales tax in Pennsylvania. You've got another state assessing use tax on you. States, you're going to be able to get a reciprocal credit towards the use tax. So you won't totally be taxed there twice, but it does create a compliance burden. And, it's time consuming, and how it all plays out sometimes can be a little bit confusing, but in general, you're not going to be stuck with both the full sales tax and a full use tax there. So, what about if it's purchased outside Pennsylvania and used for more than 7 days or consumed in a construction contract? Pennsylvania would say that is subject to tax. The construction contractor would likely be required to file sales and use tax returns in both jurisdiction and then take a credit for the sales tax that was already paid. So that's how it generally plays out. You're going to get, if you already paid the sales tax, you're going to get credit against the use tax there. And then we just provide the site for where Pennsylvania provides for this credit. But this is going to be similar across other states as far as how the credit mechanism works. Moving on here to some common rules and exemptions by state. I'm going to bring all these up here. So the items in blue here are valid exemptions. The items in gray are kind of specific to maybe that finance and revenue decision. And then the items in red are not valid. So we got one there in the bottom right corner. So some valid common Pennsylvania exemptions. So sale of tangible personal property to a governmental entity or purely public charity are exempt from sales tax. A little note here on purely public charity. I've been involved now just in the past year in 3 or 4 engagements where a charity or a nonprofit has had their sales tax exemption. It was up for renewal and it was denied. So what constitutes purely public charity comes into play there. And I feel like it used to be kind of a rubber stamped deal, but now purely public charities are really kind of somewhat under attack a little bit and are really having to prove out that they are truly not subject to tax. So I don't think too many of you are probably filling out or doing that application, but if you are dealing with entities that are tax exempt, that's something that they are having to deal with, at least in Pennsylvania, on a fairly regular basis. So some building machinery and equipment for government, charity, or KOZ projects are exempt if used to service real property. That's a very defined term. And that building machinery and equipment exemption, it's not necessarily very intuitive. There are items that qualify that you would probably think wouldn't. And then there's items that you think should and don't. So definitely dig into that rule if that's applicable to you and you're involved in real property contracts with exempt entities there. We've got the Board of Finance Revenue decision that, and there's others out there. This is just one I picked that kind of walks through that as well. Items used in contracts for manufacturers, provided the items are directly used in the manufacturing process and would have been exempt if purchased by the manufacturer. So we see a limited exemption here. We see a revenue decision that talks about that. Utilities. So this is another complicated area. I deal with this quite a bit. There is a public utility exemption in Pennsylvania. This Board of Finance and Revenue decision specifically deals with materials used to construct manholes, water mains, and sanitary sewers that are then being transferred to municipal authorities in Pennsylvania. But public utility is a valid exemption in Pennsylvania. Whether something qualifies as that is kind of another issue in and of itself. But if someone's providing you that exemption certificate, that is valid if it looks reasonable to you and it's completely, and the exemption certificate is completely filled out, etc. Items and equipment used directly for farming, including some items that are real property. So farming is another valid exemption. There are limited instances where items in the real property space are also treated as exempt. And then we got the code section and then a Board of Finance and Revenue decision that through that there. So going back to the building machinery and equipment, exemption, non-building machinery and equipment. So items that are not listed in that definition in 7201, even though they are for a government, charity, or cause project. So this area gets very confusing. I get a lot of questions on this. I feel like the exemption's probably overclaimed because it is more limited than what most people think. So just kind of be on the lookout if you've got contracts with governments, charities, or in KOZ zone, be on the lookout for this. Kind of brush up on the building machinery and equipment exemption. And if you've got any questions around that, we regularly answer questions on that. So, all right. So moving on here to New Jersey. So New Jersey uses the term, has some different terminology than Pennsylvania. They spell out contractors and fabricators. Pennsylvania doesn't use the term fabricator as much in their construction contractor sales tax law, but in New Jersey, contractors are viewed as the final consumer and are responsible for sales tax on the materials and supplies at the time of purchase. And we got the code sections there that spell that out. If you're purchasing materials outside of New Jersey and paying no sales tax or paying sales tax at a rate less than the current New Jersey rate, contractors got to pay use tax. So that's very similar to how it works in Pennsylvania. They spell it out a little bit different. They've got examples of this, though, in that bulletin I cite there. And if you've got New Jersey sales tax questions, that's a really good starting point. The law can get kind of messy if you're digging through the regulations and trying to figure out what applies and what doesn't. But I feel like the bulletin does a pretty good job of laying out in more plain language hypotheticals and kind of how those different regulations apply. So that's really a good resource if you're operating or have any New Jersey related questions. Contractors must charge customers sales tax on repair, maintenance, and installation services unless the work results in an exempt capital improvement. So exempt capital improvement's another term we don't see as much in Pennsylvania sales tax law, but we do see it in New Jersey and a lot of other states. If the work results in an exempt capital improvement, the customer must provide an exempt capital improvement form, the Form ST8, to the contractor. This then allows the contractor not to charge sales tax on that. New Jersey and New York are the only two states off the top of my head that I'm aware of that have a form like this. So that Form ST8 is New York is unique to New York, and or form like the ST8 is unique to New Jersey and New York, and you got to get that from your customer if you're in that exempt capital improvement space. Subcontractors, so they are required to pay sales tax on materials and supplies purchased for use in fulfilling contracts with New Jersey uses the term prime contractors. That's just another way of saying general contractor, unless the customer is an exempt organization, qualified business in a UEZ zone, or a qualified housing sponsor. So subcontractors, are treated very similar to prime contractors in New Jersey. But for any of the differences there, again, that bulletin is a really good resource and has good examples on which falls into which bucket there. New York. So New York gets a little messy in this space. They have the capital improvement terminology. They say that is an addition or alteration to real property that substantially increases the value of the property or its useful life. So that's prong one. It needs to become part of real property or affixed to it. So that's prong two. And then item three, it's intended to be permanent. So they get there a different way, but these are some of the same elements that we talked about in Pennsylvania, right? Intending to be permanent, fixed to the property, those type of things. So I don't think it's radically different what's considered capital or what's considered real property in New York or Pennsylvania. And I'm sure there is some variation at the margins, but they go about defining it as a capital improvement. So then contractors pay tax to the supplier when purchasing materials or supplies for real property or capital improvements, and no sales tax is collected from the contractor's customer. So similar, it's our general framework there. New York's got a publication similar to the New Jersey SU3. Another good resource is this publication. It's 862 is New Jersey's contractor, or is New York's contractor sales tax publication. Similar to the ST8 in New Jersey, New York has this form ST24 that the contractor needs to get from their customer to not charge sales tax on that. Tangible personal property. So contractors must pay sales tax. Contractors must pay sales tax when purchasing tangible personal property, regardless of whether it's going to be used in performing a capital improvement or repair, maintenance, or installation services. See that spelled out here in this New York regulation. When dealing with manufacturers, so when incorporating manufactured product into real property, the manufacturer contractor is subject to use tax. So that's similar there. They're going to be considered the end user. That aligns with what we've seen in Pennsylvania. Where New York gets complicated over here is with repairs and maintenance. So when a contractor is performing a repair or maintenance service, they pay tax to the supplier on the materials and collect tax from the customer. The contractor is then entitled to a refund or credit of the tax paid on the materials transferred to the customer. So this is messy. It's a compliance burden. I see this get messed up regularly, but this is how they handle this, is detailed in that New York regulation there, 541.5 D3. So Virginia is a little more straightforward. They've got a primary purpose rule that we'll talk through here in a minute that's a little different than some states, but contractors are viewed as end users or consumers and must remit use tax on the purchase price when purchased, unless the property is going to be used by a governmental unit or agency. So we do see a limited kind of flow-through exemption here in Virginia, personal property. Contractors that sell TPP can purchase the property exempt using a resale certificate. So that makes sense. They're treated like a normal retailer, and just kind of another, you guys still got to collect the resale certificate. If you're audited and you're selling tangible personal property, the onus or burden is on you to prove out that those sales are exempt. We'll touch on this in a little bit, but in more detail in a little bit later on. Most time you can go back after the fact and get those certificates, but what happens if your customer's out of business, or maybe the people that handled sales tax are no longer with that department, or they didn't maintain record, those type of thing. It's just so much easier to get it right up front than to try to have to go back after the fact and prove it out after you get an audit notice. So fabricators, these are contractors that manufacture tangible personal property for resale, but also incorporate into real property. And the state follows what's called the primary purpose rule there. It's pretty detailed. If you fall into this bucket, I would suggest just reading through that and seeing, how that plays out for your specific facts. All right, moving on to some among states here. So some states differentiate contractors as consumers versus retailers based on the type of contract. So there are states that will treat you differently depending on whether it's a lump sum, cost plus, time and materials, or some other type of contract. We see that in Colorado, Florida, and Texas. They're going to treat a contractor as a retailer if the contract is time or material or retail sale plus installation. So these are instances where it goes against our general framework of a contractor being viewed as the end user. So type of contract in these states there. The states also vary as far as what constitutes real property and tangible personal property. Some examples where states have different rules is carpeting, portable grain bins, signs, light fixtures. There's a number of states that classify that as real property, and then some states that classify that as tangible personal property. So you can't really make the assumption that if, for example, you're operating in Pennsylvania and Pennsylvania says a sign is real property or vice versa, that in turn, other states are just going to also kind of fall in line there. And there definitely is some variation among the states. We also see variation among states regarding whether an owner's exempt status essentially flows through and allows the contractor to purchase the materials tax exempt. In Illinois, we see that state will exempt projects where the owner is a charity, religious, or educational organization or governmental body. So it's specific about, what exemptions are going to flow through. Michigan, contractors generally may not claim an exempt entity's exemption unless you're dealing with a church, a nonprofit hospital, a convention facility, or a qualified nonprofit housing. We see that play out in this Farnell contracting case. These are very detailed and aren't necessarily logical. But this is kind of how states have autonomy. They're not governed by there's no uniform federal sales tax law. So you're going to have variations across the states. And then, whether this was lobbying or whether this was just, this particular Court of Appeals, essentially their interpretation of the law. I mean, you're just going to get variation among states as this stuff plays out. So exempt status might depend on whether a contractor or project owner buys the materials. So I run into this a fair amount, and there may be an exemption if the governmental entity is buying it, but not if the contractor is buying it for the governmental entity. So just because you find some language in a statute or regulation that this is exempt, make sure it's actually exempt for the contractor if you're the one buying it, and it's not just specific to, for example, a governmental entity making that purchase. This is just a little bit of a kind of a summary of how this, we've talked about this on the previous slide, but they differentiate based on contract. They'll differentiate based on definition of real versus tangible personal property. There's variation among whether the exemption certificate, whether the exempt status flows through. I mean, these are just some of the common ones. There's also variation among whether they'll accept another state's exemption certificate. It's just, the states, like I said, have autonomy, so there's a whole lot of variation, and it makes it hard from a compliance perspective for somebody that's in-house and got to manage this. But yeah, it varies by state, and you're always smart to look into the specific state's details as opposed to just presuming because your home state treats it one way that another state's going to have rules, because unfortunately that's just not the case. And then these are some of the specific examples of variations that we talked on previously. Illinois with that very specific categories that qualify for the exemption. We see that Michigan contracting case there, and then Florida is just complex in this area. They've got the special thing where if it's retail or if it's time and materials type of contract, they'll essentially move contractors into the retailer bucket, and they've just got a whole lot of variation in that state. So if you're dealing in Florida, make sure you read up on those rules, or get us involved, get another accounting firm involved that specializes in this area, because it does get very complicated and we see mistakes on a regular basis. So moving on here to benefits of using a SALT advisor. Some of the things you've heard me touch on earlier, that's kind of some of the things we'll flush out here. As you know, working in this area, it gets very complicated. Sometimes the guidance out there is not great as far as what's put out by the states. It's always nice when they have like a thorough location like New Jersey does, but not all states have that, unfortunately. So where do we come into play? So we will often get brought in at the, we've now received an audit notice. Can you help us out phase? We really like to get involved earlier than that. It's better from the company's perspective, and we can really even help more. We can help from a dollars and cents perspective. Once you've got an audit notice, we regularly get those reduced or even sometimes wiped out. But it's better if we get involved before that happens, and we're doing like an invoice review, and we're holding the meeting and understanding your operations, and then maybe putting together a matrix that details how taxes is handled in the various states and for the various items that you're selling or installing. Really good to just, if you've got any questions on that, get it resolved up front. The way this works out, unfortunately, is so you're not handling something correctly. You could be missing out on a large refund opportunity for one, but if you get that audit notice, you could be, if it's the flip side of the coin, be looking at a large exposure. And states can go back to the date you first had Nexus and assess tax if you haven't been filing in that state. If you have been filing and it's the incorrect amount, there's a statute of limitations. But when you start layering in penalties and interest, it gets pretty severe. So, and that's not even accounting for all the time that you'll have to deal with the audit. So, yeah, and one last thing on that, I caught that last bullet there as I was switching slides, but we also regularly, I've probably done this again 3, 4, 5 times within the past year, where a company's just brought us in and said, hey, can you train our accounting department and our project managers on how this should be handled? And just kind of put together like either a PowerPoint or like an Excel file and walk through the various scenarios and when something should be taxable, when something should be handled a certain way. We walk through all those depending on the specific facts. So we're also happy to do that as well. Managing exemption and resale certificates. This is a big item. Again, it just gets complicated. There's states that won't accept an out-of-state certificate. There's states where certificates expire. In general, you should probably get them renewed every 3 to 5 years, but there's states, Florida Arizona, Alabama, for example, where certificates are supposed to be renewed every year. So again, just a lot of variation among states. If you are reviewing an exemption certificate, your responsibility is essentially, you don't have to delve into their business and prove out their exemption, but it has to kind of pass the smell test more or less. And it's definitely got to be complete, signed, those type of things. So you definitely want to check and make sure it's at least passing the smell test. And it doesn't hurt to follow up and make sure if you've got any questions, understanding why they think that item is exempt. So how can solid advisors help? We've kind of touched on this a little bit. Some of the items I want to highlight on this slide, though, if it's surrounding manufacturing exemption, Pennsylvania and other states' rules around that are very detailed. For example, when does the manufacturing process start? When does it end? What's considered manufacturing or processing to be included in the exemption? We do a lot of work around that, so that's something that can come into play. If you're purchasing or selling equipment, I've seen instances where taxpayers have kind of just had a blanket assumption on that one way or another. There is variation among states, and we regularly look into that. Those tend to be large dollar purchases or sales. So this is a big one in Pennsylvania, and I know it is as well in other states. Software, digital goods, and related services, states are really aggressively auditing and imposing sales tax on that. And you may at first read think, well, this doesn't apply to me, but I mean, it's anything like an ERP system. It applies to advertising. It's much broader than what you would think. In general, most states tax can software. So that's software that's not customized for a particular user. That's the bulk of software. There's also what's called, for sales tax purposes, custom software. A number of states don't tax that, but it's got to meet that definition. And that's kind of where the devil is in the details. So if you're doing anything around ERP systems, software related, advertising through softwares or something, make sure you're examining that and understanding if sales and use tax is being handled appropriately, because I've seen Pennsylvania and other states become very aggressive, including aggressive in regards to contractors with those items. So I'm involved actually in 2 different Pennsylvania audits right now where the big ticket items are software or digital advertising related. Another hot button issue is what's called help supply services. So traditionally, this would be the scenario where maybe you need some help on the production floor, or you're struggling to get enough employees and you're using a third-party employment service that's providing employees for you. They aren't your employees. You're actually paying the third-party company. What's taxable there in Pennsylvania and some other states is that fee charged by the third-party company. The labor of those employees is not taxable, but where companies are getting tripped up is not having that documentation. So it should be broken out on the invoice and spelled out in the contract what sales tax is being on. Pennsylvania historically would allow you to go back and get an email or get something from that third-party company saying, yes, here's the portion that's subject to sales tax. Here's the breakout of the employee labor versus our fee. But they're no longer allowing you to do that. If it's not shown on the invoice, they're not allowing you to go back after the fact and get that support. They had a publication that spelled that out earlier this year, and they mentioned it in regards to refunds, but we've since then heard that it's being applied under audit. And so, just be mindful of that. I would also say be mindful if you're using help supply services from a related party company. So you're not even going out in the marketplace and engaging, a third-party agency. It's just your structure where you've got a related party providing those services. They are also attacking those items. So again, it's a documentation issue, making sure you get all your ducks in a row, because you certainly don't want to be assessed sales tax on the labor portion of that. All right, so moving on here to some other business taxes. So sales tax has been the focus of this webinar, but contractors, like every other taxpayer, also have to deal with income, franchise, and gross receipts taxes. So in general, if you're performing a job in a state, that's going to create nexus, and nexus is a fancy word meaning connection. And if you have nexus or enough of a connection in a state, you then have to comply with that state's tax laws. And so if you're doing any jobs in a state, that's going to create nexus for sales tax, income tax, franchise tax, and If the state imposes a gross receipts tax, that tax as well. A lot of construction contractors are structured as pass-through entities, and this can involve cumbersome filings involving non-resident withholding. You've also got to determine maybe a composite tax return. Makes sense if you've got non-resident owners. And then also PTAT elections. So that's pass-through entity tax elections. Those are offered by a majority of states. Pennsylvania doesn't have one, but most other states do. PTAT elections can be very advantageous if you're profitable. It's essentially a free federal deduction or an increased federal deduction. So going into these in too much detail is kind of outside of the scope of this, but they can be very beneficial in most scenarios if you're operating outside of Pennsylvania. States have gross receipts taxes. I mentioned Delaware, Ohio, and Tennessee here. Washington, Oregon, Nevada. I mean, there's a bunch of states now that have them. And it's a gross receipts tax is what it sounds like, where a sales tax is levied on taxable sales. So you may have some exempt sales. Those aren't going to be taxable. An income tax is levied on taxable income. So you're going to get some deductions and eventually get down to the taxable income. Not a gross receipts tax. It's top line revenue sourced to the state with a very few exemptions. So if you're operating in the states that have those, make sure you're mindful of those. I've seen significant exposure numbers pop up, and taxpayers said, well, maybe, for example, I was operating at a loss. I didn't even know, how can I be taxed? And it's because it's based on sales or revenue sourced to the state, not taxable sales, not taxable income, anything like that. So, and then a note here, many southeastern states have net worth taxes. Tennessee is one. There's others out there. Georgia has one as well. So also be on the lookout for those if you're operating in the Southeast and other parts of the country as well. Just a quick plug here for due diligence. So I see this far too often. If you're a contractor or construction company here and you're considering selling in the next 3 to 5 years, or you're working for an owner and the owner's, kicking around a sale, you really ought to do sell side due diligence and get all of your in a row from a potential tax exposure perspective. I do a lot of work for private equity firms and companies that are basically in the business of buying other businesses. And they always bring in an accounting firm and a law firm that request your prior tax returns. They do a deep analysis of whether you've been properly handling sales and use tax. And then what ends up happening is there's a large purchase price adjustment or escrow set aside to account for those exposures. And it's just always better if you're on the sell side to have somebody do that for you. Then you can push back on that, and you've got a nice buttoned up report that says, here's where we did have some exposure. We got that cleaned up. Or even if you didn't get it cleaned up, you're no longer getting that worst case scenario imposed on you by the buy side. So just something to consider. It's never too late, but it is ideal if you can do it, not 3 months from when closing is. Just kind of a summary slide here. We've touched on these items, but these are just some of the ways we can help you. Purchase and sale transactions. We can analyze your SALT processes. Any questions on exemption certificates? We kind of run the gamut on the services we provide for this space from a SALT perspective. And with that, we are at the Q&A session. So
thanks, Matt. We do have a couple questions, but a reminder to our audience that if you type them into the Q&A box, we can add them to the queue. So Matt, our first question is from Minnesota. We're a plumbing, HVAC, and electrical company. We are not tax exempt. However, we have been told in Minnesota, when providing a service, you do not have to tax parts. Does that mean we shouldn't be taxed when purchasing parts?
Yeah, so that's a good question. I did have time to peek at Minnesota's law on this. So when you're purchasing parts that are going to be installed into real property, the HVAC company would pay tax on the purchase price of those materials. And that kind of goes back to our general framework that you're considered the end user. If you were reselling those and it was a tangible personal property scenario, which is not generally the case for an HVAC company, that'd be a different story. But yeah, you would have to pay tax on the purchase price of the materials. And then in turn, you would not charge sales tax to your customer for those parts, which makes sense because it's only going to be taxed once. And the HVAC company in this would be considered the end user in Minnesota.
Gotcha. Our next question is from South Carolina. How is sales tax handled for lump sum out-of-state contractors?
Yeah, so I'm scrolling over here on my screen. Pull down. Yeah, so I also looked into this one. So in a majority of states, the contractor is going to be considered the consumer of the materials and the supplies used in a lump sum contract. The contractor would pay sales tax when purchasing the materials and supplies and will not sales tax to the customer. The labor charges are going to be subject to sales tax in a majority of states. And then for specifically in South Carolina doesn't specifically classify types of contracts by form of payment, whether lump sum, itemized, or otherwise. So South Carolina is going to follow our general framework there. I do note here that states also vary regarding whether lump sum contracts are treated differently from itemized or separately stated items on a contract. Most states, including Pennsylvania, don't distinguish. So Pennsylvania and South Carolina are somewhere there. They don't distinguish or tax lump sum or separately stated contracts differently. However, as we saw earlier, some states do, including Texas. So if a contract is lump sum, Texas will treat a contractor as a retailer. So, we talked about that general framework earlier where you're either considered, you're operating in real property scenario, where you're considered the end user. And that's what we just touched on with the HVAC company. And then this question here, or you're considered more like a general retailer where you're selling tangible personal property and you would have that tax collection function. And we see here Texas will kind of flip the script on you and make you a retailer if you have certain type of contracts. So
we have a follow-up question from a home builder here in South Carolina.
Okay.
We sometimes hire lump sum subcontractors from out of state. How can I know if sales tax was paid for the material used, and would I be responsible for that payment?
Okay, so is the other, I guess if the other company, if you're hiring a company and they're the ones that purchased the materials, and okay, so they're functioning basically as a general contractor, the home builder would be, I assume here. Yeah, so no, the subcontractor, if the subcontractor is the one purchasing the materials, they would have the obligation to pay sales tax most likely in that state. And then when they come into the state and install those items, they would be considered the end user and would be responsible for use tax. And then that mechanism that we talked about would come into play. We've talked about earlier in the webinar would come into play. And that state where they paid sales tax, they would get a credit in South Carolina in this case for that sales tax that was already paid.
Okay. Our next question is, what audit issues are most common for construction contractors in your experience?
Yeah, so I do see states regularly attacking those items that are kind of at the fringe of real or tangible personal property. We flushed some of those out earlier in the presentation with the Pennsylvania, like the Sheets case, and we talked about the MRI machine and some of those other items. I see that under attack in a lot of states where a contractor will classify it as one way and handle sales and use tax a certain way. And then the state will come in and say, no, actually, this should have been treated as maybe real property when you were treating it as tangible personal property or those type of things. Something that's kind of so shocking to me that I'm seeing a lot for contractors is that whole software thing and digital advertising and stuff. It's just something I don't think is top of mind for most contractors, but I'm working with a company that installs kitchens right now. They're a fairly large that does that. And their big issues in this audit are essentially related to some of the software items and the digital advertising and that kind of stuff. And I think where it's catching contractors and other taxpayers off guard is it's not, in general, you just don't think of something like that. It's not tangible in general, right? And so you don't really think of it as tangible property. And so you don't think sales tax is really an issue. But it's just states are coming out and defining software and defining digital advertising as tangible personal property, or even saying it, it's an enumerated taxable service. So I would say those are the two things I'm seeing right now that are probably the biggest issues for contractors.
Interesting.
Yep.
The next question is, what should the construction industry know from a SALT perspective related to the One Big Beautiful Bill?
Yeah, so there's a whole lot of changes in One Big Beautiful Bill. I know for federal and international and a whole bunch of other areas. On the state and local side, there was a bunch of pretty significant items that were considered that didn't end up making it through. And I think the biggest takeaway is that pass-through entity tax elections are still an option. So if you're operating in a flow-through structure, you're an S corp, partnership, an LLC, and you're profitable and you're operating outside of Pennsylvania, there's a really, if you haven't been analyzing and looking into those pass-through entity tax elections, one big beautiful bill was on the table at one time that they were basically going to adjust how that regime worked. After a whole bunch of talk and proposed amendments and everything else, we basically walked out of that with business as usual, which is a good thing from a state tax perspective. It still leaves those PTET elections on the table. So that's definitely something you should be considering that was a result of that.
We have several more questions. Do resale exemption certificates expire?
They do in some states, and you're always learning. I was on a call. I didn't think it. In general, no, they don't. Most states they don't expire, but in some states they do. Florida is one example. I believe Arizona and Alabama are other examples. But yeah, it varies by state. They don't in Pennsylvania. Then I've seen other states where they've come out and they said, well, we recommend, we don't require, but we recommend that you renew them every 3 to 5 years. So you'll really see variation across the states on that. But to answer your specific question, yes, in a handful of states, they do expire.
Okay, let's see if we can squeeze 2 more in here. What's the biggest risk and the biggest opportunity you see for construction contractors related to SOL?
Yeah, I think they're kind of same flip sides of the same coin. The risk is doing nothing and not analyzing how sales and use tax should be handled, because you could be doing it wrong. And then, 3, 5, 7 years down the line, you realize you've been doing it wrong and it's a massive exposure. And the opportunity too is get that, make sure you got your sales tax house in order there. And because you could be looking at a refund review. And that's something we do, or a large refund. That's something we do on a regular basis, is analyze your invoices and your operations, have conversations with you. And sometimes we'll do those on a contingent basis. I've seen very large refunds. Just in the past year, I'm working on 2 separate refunds that are going to be north of 6 figures for construction contractors. So opportunities on the refund side.
See if we can squeeze this last one in. Once again, from our friend in South Carolina. For online material purchases, is freight taxable?
So the taxability of freight oftentimes will follow the taxability of the item being purchased, but that's an area that varies quite a bit. It depends on how the item's being delivered, whether if it's being ordered online, it's being shipped to you. Yeah, there's variation by state on that, but it's in general going to follow, as a general rule, it's going to follow the taxability of the item.
Fantastic. I think we've reached time, Matt. I want to thank you, and I want to thank everyone for attending today. You'll see our contact information here on the screen if you'd like to continue the conversation. And we hope that you all have a great afternoon and join us for our next presentation. But thank you, Matt, and thank you all for attending.
Thanks, everybody. Thanks, Ben.